I'd like to take the opportunity to give you at least a brief introduction to Sabina and our Back River Gold Project in Nunavut. There's really four pillars, I think, to Sabina and our Back River, our assets. It is a world-class district, best in class. These are the highest grade undeveloped open pits in the world of over 500,000 ounces. Feasibility complete, shows a good production profile, 12 years, averaging about 200,000 ounces per year. That is front-end loaded, those early years up to 242,000 ounces per year. Economics were done at a modest $1,150 US gold with an 80-cent dollar. At that, showed a 24% after-tax rate of return, and certainly at today's prices, which I'll talk about, offers even more potential. And in potential, being part of a district, we've been focusing largely on an 8-kilometer segment on this belt. It is an 80-kilometer long prospective banded iron formation. Of our total reserves and resources, we're about 5.2 million ounces in measured and indicated at over 6 grams in measured and indicated, an additional 2 million ounces in inferred, and 2 million of those ounces sit about 50 kilometers away from our base of operations, or the area that we've pursued the feasibility on within this same district. Again, so this district has proved productive from a raw resource in a similar grade potential. We made 3 very important discoveries since our feasibility, and all of them have very significant components that are higher than our average grade, and not unusual to see 10 and 15 gram intercepts over very good widths within these new discoveries. There are a number of low-risk conversion opportunities, i.e. inferred to measured indicated, plus a number of targets that have been worked up and are ready for additional exploration and drilling. Post-feasibility, we've also worked very hard on de-risking the project. There's certainly, because of our location, some logistical and infrastructure items that we have to work through, and I think we've done a very good job at that. Now testing our entire supply chain from our consolidation point in southern Canada by sea and by land all the way to our sites, so including building our port facility and operating our road logistics routes. Have also received our Inuit IIBA, and along with all of our permits, and the permitting exercise was close to $40 million in 4 years. An expensive permitting regime, but also security of title that rivals no one in the world. A strong balance sheet at the end of last quarter. It was put out last week, a little over $22 million. And I think the last pillar, certainly an important part of it, a team who's been through this before, not only successfully explored, but also developed and operated projects in logistical challenging terrains. Nunavut is where both of our assets are, both our active asset, which is the Back River Gold Belt, and our passive asset, which is a silver royalty on the Hackett royalty. That is a 22.5% royalty on the first 190 million ounces of silver produced. So it works out to a cash equivalent of a little over 40 million ounces to Sabina. If we look in Nunavut, it's a long history of operating the mines. When we look at logistical methods, every community in Nunavut has the same logistics, and that is summer sea lift with air support in the non-ice-free season. There are no roads from outside Nunavut to inside Nunavut. 100% of all energy in Nunavut is generated from diesel, and there are no roads in between major communities. There's currently 4 operating gold mines, 2 open pits, 2 underground, operate 365 days a year. But I think the real challenge is certainly a security of tenure, and district scale opportunities exist in Nunavut, and we've seen success of that time and time again with previous operators. As I've said, Back River's shovel ready. We have not only completed economic studies, but taken it beyond basic engineering and into detailed engineering. The very high-grade nature of these pits certainly contribute to their economics. If we look on that top slide, and these are the highest grade plus 5 million ounce development assets in the Americas, the 2 that are higher grade are 100% underground. When we look at this, we're 72% open pit, 28% underground, and at 6 grams, again, something that very few companies can offer. The current mine plan is what we call the initial project, and that is starting with 2.3 million of that 7.3 million ounce resource, and still a very strong production profile. We focused on really simplicity, simple executable mine plan, one open pit at a time, followed by one underground post-payback years. And again, we've demonstrated that not only is the conversion opportunities for additional inferred into measured and indicated, but 3 additional discoveries within that 2 to 3 kilometers of the proposed plant. Post-feasibility, post-engineering, we continue to create value. And again, a big part of Sabina is the logistics and infrastructure challenges. And again, 6-gram pits afford you that opportunity to overcome. Again, this is not something that hasn't been done in the past. And again, many operating mines, some with significantly more difficult logistics and infrastructure. The Lupin mine would be a good example. That was a 620-kilometer winter ice road, no port access. What we have done since our feasibility and since early construction is have actually built and operated our port facility. 3 successful sea lifts, again from our supply route and consolidation points, which are Hay River and Bécancour, Quebec. That is on the top left photo, shows our airstrip landing area port facility. The other photo on the right is part of our winter ice road, again moving all of that equipment and supplies from the port facility to the mine site. On the bottom is something we just completed this summer, is 10.5 million liters worth of fuel capacity. So we now have the ability to significantly lower one of our largest costs, and that's energy, with being able to bring in fuel by sea. Continue to focus on exploration. Again, 3 other discoveries that since our last resource update. One of the other things that we will be talking about in shortly is again giving some more insurance, some more security to that CapEx number, and that is converting our EPCM or time and materials to a fixed-priced EPC contract, where again we're offloading some of that risk onto constructors. If we look at all of the Western gold assets, this is an RBC map, slide that is very simple. This is grade on the vertical axis and size on the horizontal axis, and we can see where we sit on that. There's 2 projects that certainly sit higher. One is in Ecuador, one is in Colombia, and both of those higher cost on a per ton basis, significantly higher cost because of their 100% underground projects. Again, with the additional discoveries that we've made at Nunavut, with Llama Deep, with Vault, we know that what we're doing is introducing higher grade and also more ounces. But certainly it's a compelling asset and stands out when benchmarked against all other assets in the gold development space. We talked briefly about the team. Again, I think we've been involved in over 80 projects and companies, operating everything from 300 ton a day to 50,000 ton a day mines successfully, building mines in the north, operating, financing, and also in the right financial markets, being able to take some of those assets and create M&A that is accretive to shareholders. So I think that is at least a brief summary, and either myself or Nicole Holler have some time over the next 2 days if there are any questions, and I probably have time to entertain one question at this stage. Go ahead.
It would seem you, Jose Prime, taking over Canada. Can you talk in general terms about levels of prospective interest you've had?
No. M&A is not something I think that is a public disclosure. What I can say is certainly assets like this. We've never run a formal process. Today we trade at about 0.45 times NAV. Premiums, the market thinks premiums are anything from Mark Bristow's 0 premium to 22, 26%. This is not an M&A market where one should be putting a for sale sign on. If you look historically, his assets like ours would trade at 0.6 to 0.7 times NAV. And when there are M&A markets, 35+% premiums have not been unusual. And I think in a market like that is where we have the opportunity to look at an either or. Thank you very much.